Are you a benefactor of a credit union deferred comp plan? Listen carefully. In my 34 plus years of providing financial services, one of our strategic plans is to pass wealth down with the use of life insurance. I know that shouldn't be a surprise to many people. $1 buys hundreds of dollars of death benefit, so it's very leverageable. Also, life insurance proceeds, if structured correctly, are payable totally tax-free to the named beneficiaries. They could also be unencumbered by any creditor. It can be a wonderful tool to create legacy estate equalization. For example, if one child inherits a business, the other child inherits cash. In another situation, it could also be used to create liquidity to pay taxes on to the federal government and keep an entire estate intact, such as land and business and buildings for heirs. One particular policy that has been used and designed by the insurance industry for these particular types of planning is called a second to die policy. It's designed for couples who want to share a life insurance policy with specific beneficiaries such as children and possibly grandchildren. The life insurance company only makes a payout to the beneficiaries after the last of the survivor dies. When we explore second to die life insurance, it becomes a very attractive planning tool. Insuring 2 lives on one policy is usually much more inexpensive than 1 life on a policy. Obviously, due to the fact that it pays at the second death. The mortality expense is spread over 2 lives. In addition, many of my senior clients find that by creating this specific policy and putting it in a protective trust, such as an irrevocable trust, it guarantees a legacy for their heirs no matter what happens to their estate, such as if they became disabled and needed long-term care protection, and they have some of their assets or estate consumed by these costs associated with that care. A life insurance policy and an irrevocable trust over a period of time could avoid all of that. So while second to die life insurance is more affordable, it is oftentimes easier to qualify for because even if one person is not that healthy, as long as one of the two are healthy, the life insurance usually can be placed. It's a tremendous estate planning tool. It's very customizable. So when choosing a policy, you can really work with a company that really provides for your particular situation. Some drawbacks, of course, could be if the people on the life insurance policy divorce. Usually, there's plan provisions that cause for that policy to be separated, but it can get sticky. Also, final payouts to the heirs may take some time for the second person to die. Still, the bottom line is life insurance can be a really helpful tool to protect the interest of your heirs. If you're in a situation where your spouse won't need a death benefit to make ends meet, the second to die policy is a tremendous tool. It's a relatively affordable way to provide a tax-free environment for heirs and also gives you the permission slip to spend down other assets that you normally would be thinking you'd want to leave to heirs. Finding the right contract is really important. You need to ask a lot of questions and clearly identify your goals. So, why am I sharing this concept with you as a credit union executive? The exit strategy from your deferred compensation plan through the credit union should be carefully considered when you become vested. Tax ramifications, estate issues, and so much more should be discussed. We found that in some cases, a survivorship policy, that second to die policy if you will, can be a great tool to explore for some of the proceeds of your deferred comp. The cash that accumulates inside these policies could be ultimately used by the people setting up the contract and accessed on a tax-free or tax-favored basis. These concepts are worth exploring, and we'd love to help with you and that discussion. Thanks for watching. Please share with others who might find this message valuable.